Good morning, everybody, and welcome to the Hardcore Mortgage Real Estate and Business Podcast. Today is Wednesday, February 28th. I'm joined by Mr. John Kolb and Mr. John Kolb only this morning. Good morning, John.
Good morning. How's everybody doing today?
Everybody around the world says hello. Scotland, Ireland, a couple places that you're familiar with. Also in the great states, all 48 contiguous states, and the two that we like to call Alaska and Hawaii. Everybody's listening all over, John. And I want to point out today would be normally the last day of the month. But since it's a leap year, we get an additional day in February, John. I feel really good about that. How about you?
I mean, it's if we could keep the 70-degree weather, which I think we're losing it today, I'd be very, very happy with it. But it's other than that, it's looking good.
So yesterday, Tuesday, February 27th, I'll be a meteorologist here. Or do I have to have a piece of paper for that? Oh, I'll just print one up on my computer. It was 73 degrees here in metropolitan Detroit. And today, when I took my dog out for a walk, it was 40 and windy. So, John, we're not keeping this weather. It's not the end of winter. You know how it is around here. The weather, you stick around here, you can get winter, spring, summer, and fall all in a 24-hour period.
Yes. And you know what? We're coming to the end of that, I think. And let's just hope that we have a good spring and summer, and everybody is healthy and has good business going on.
Yeah, well, I appreciate you joining. It's only you and I today. Becky Alley is on a plane. She's going to an important meeting in Florida. Lisa Lawson's working on. She's got a lot of buyers coming out of the woodwork. All of a sudden, all the pre-approvals she did over the winter are starting to pay dividends. Harvey Freed is having lunch with one of his real estate partners today. So, John, it's you and I. And what I'd like to do today, John, because it's you and I just want to geek out on some numbers and kind of educate people what's going on and kind of give our slants on the numbers. Are you ready for that?
Let's do it.
All right, beautiful. All right, today's podcast, Hardcore Mortgage Real Estate Business Podcast for Wednesday, February 28th, brought to you by Capital Mortgage Funding, powered by CMG Home Loans. 1820 is our MLS number. We'll get that out of the way. And we're going to try and equate all the numbers to what we see, John, going forward, what we're experiencing. But first of all, how's this market currently been for you and your realtor and referral partners? What's going on in your world?
I mean, it's still slow. Everybody wants it to start popping sooner than not, just because we've been so slow for so long. There's too many people that are on the fence. They just don't understand that if they keep waiting and waiting and waiting, they're going to lose equity over and over and over again. Forget about the rates. Who cares about the rates? I had a conversation the other day with a client, which was more of a cash out transaction to pay off some debt, and they wanted to know what the rate was. I said, let's not even take the rate into account. Let's just take monthly payments into account for the time being. I'll talk about the rate after we figure that out. And we figured out what he was paying in credit card debt, what he was paying on his current mortgage at a 2.99% interest rate. And then we figured out what he would be paying on his new mortgage after we pay all the credit card debt off. And it was saving somewhere around $800 a month. Now, who cares about the rate at that point? It's $800 a month that's going into your pocket. That's 72. No, what is that? Why is my math so bad? Is that $8,400 a year, right? So let's not talk about the rate, but that's where buyers are. They're worried about the rate. They're worried about the interest rate. They've lost buying power because the interest rates are going up. But what I keep telling people, you're going to continue to lose buying power when the equity, the values keep going up. So you might as well get into it now, build some equity. And then when the rates come down, if you want to sell, sell. If you want to refinance. Let's not worry about the rate.
Yeah, when we say the market and things are slow, it's the people that are waiting, like you've made direct mention of, that are really losing out, John. Because right now, and here are some numbers, and I said we're going to geek out on some numbers. We want to point this out. Those people are waiting. You've heard us say it for the last few months. If you're waiting, you're losing money. You're not gaining anything. You're losing. January 2024, just last month, existing home sales very, very strong. Seasonally up over 3% from December of 23. So January's numbers were up. over 3% from the previous month. And the previous month, is historically a little bit slower because of the holidays, John. But the sales trend is upward. So if the sales trend is upward and there aren't that many homes coming on the market, all right. And by the way, the seasonal adjustment now, because of how busy it is in home selling around the country, has been adjusted to up over 4 million homes to be sold in 2024. Where those homes are coming from, I don't know, but the initial projection was 3.780,000 homes as opposed to 4 million. Yeah, it might be a modest increase, but it's an increase in overall projections nonetheless. John, I still say inventory is going to be an issue, but you know what isn't going to be an issue, and it's going to be a constant? Home prices are going to continue to go up. So if you're going to go ahead and wait, John, it's supply and demand. Let's talk about that. Econ 101, John.
Yeah, there's no houses to buy. So builders are going to have to get out to keep buildings. Sellers are going to have to get off their butts and start selling some homes, and getting people start to list. And we talked about this on the radio, what was it, 2 weeks ago? Maybe start to list a home with the reverse contingency, where the seller doesn't close or an appraisal isn't ordered until they've found a new home. Yes, that can create a real backlog and somebody who has to wait, but it's something different, and maybe it'll help trigger some more sellers to get out there. And the more people that kind of kick into that reverse contingency, where the seller is putting his house on the market contingent upon them finding a new home, maybe more and more people start to do this, and we open up the doors a little bit. But yeah, you were right. Economics 101. The more people that are out there looking to buy a little bit of homes, the homes are going to sell for more. So, if you're waiting, you're just going to lose over and over and over again. The stats all say it. The history all says it. Real estate is a way to invest. Yes, there are times when the bubble bursts and the values go down, but you can't look at that short term. You have to look at this as a long-term investment. Get your money into a real estate. It's going to go up and down, some ebbs and flows. But then at the end, down the road, is the hope that the values are going to get you out the money that you want. Or worst case scenario, Harry, the values stay the same, but you've been paying down the equity of the home. And now when you go to sell, you've got something to realize and some gains. Where if you're just doing this with a rental, you're just throwing money away. You can't sell. You're never going to get any money back.
Yeah, and mentioned in the previous segment is that if you go ahead and you buy a house now, or you refinance your house now and pay off debt, like you mentioned, save $1,000 a month with this, which is a substantial amount. If and when rates go down, John, we can always refinance you into a lower rate. So if you're renting, you're paying 100% interest. If you buy a house now and rates are still in the 7.25 range right now, John, on a 30-year fix, somewhere in there. If rates go down, you're going to be able to get a lower rate, a lower payment anyways, but you will be able to take advantage of that appreciation, which right now it was double digits. It's probably going to be somewhere between the 5 and 7 range for 2024, but that's an investment. Okay, you're making money that way. By waiting, you're losing money. So Fannie Mae, John, came out and said they're optimistic about a housing market recovery in 2024. And what's fueling that speculation, again, it's just a speculation, is that they believe that builders now, like you said before, builders are building more houses, and more new construction homes are going to come on the market by the end of the year, coupled with what they believe. I stress that they believe that interest rates will start heading down. So therefore, more houses on the market, new construction, coupled with rates coming down, could add, and as they say, Fannie Mae optimistic about a housing recovery in 2024. What are your thoughts on that?
Well, there's a couple things that I want to focus on. What you said, Harry, is that you're saying that a rental, you're paying 100% interest, and so I'm going to be the naysayer, the guy that sits there and texts us during the radio show because he's too scared to make a phone call. saying, well, when you buy a house, Harry, and you take a mortgage out, the first 5, 6, 7 years, you're paying up pretty much 100% interest as well. But you hit the nail on the head when you said, but you're missing out on the appreciation. Renters will never get any appreciation. When it comes to building, who was it? Mark Twain that said buy land because they're not building anymore, right?
That's right. They're not making any more land, brother.
They're not making any more land. So the problem with that is in the areas that people want to buy in, there's nowhere to build. So, yes, you can let's just take our little microcosm here that we have. Royal Oak, Berkeley, Beverly Hills, Birmingham, Oak Park, Madison Heights.
Huntington Woods.
Yeah, where are you going to build, right? Unless you find something that you're going to completely tear down. So, but I don't consider that that is a new build, but that's the same problem that everyone's having is that it's not like there's places where they're throwing up hundreds of homes in subdivisions in the populated areas. There's onesie twosies going on, but those onesie twosies are going to be taken off the market right away because it's going to have the same problem that everybody else has, is that somebody wants that house. It's going to sell right away, even before the guy put his second nail in the frame. So, it's really, really hard. People are going to have to start pushing themselves out to the outskirts of the populated areas to try to get some land. These builders are going to have to start doing, building that, but that's a big risk, because what happens if people don't want to be 45 minutes away from a city? They want to be 20 minutes or closer to a city. Then you've got some issues. So that's one of those things that we'd have to get a round table around and sit down and talk about, and brainstorm and powwow, and like the old days, they probably had smoking chains going on in those things and getting all the answers done. But those are one of the things that we need to do, is where sit around and kind of brainstorm how best to fix this issue.
Well, they've already figured it out in certain areas, John. I'm going to go back to what you said. If you take a look at the Woodward corridor here in our area, okay, all up and down Woodward from Ferndale all the way up through Bloomfield Hills and all the cities in between, you are seeing that infill building. Okay, you're seeing houses being torn down and new houses on those little blocks, whether they're 40, 50, or 60-foot lots. You're seeing it all over. And what that is doing, John, again, if you're waiting to buy in those areas, what these infill builders and these people building these homes are doing, they're increasing the values of the properties all around them. So to get into that neighborhood, it's going to cost you a lot more money. So this whole wait thing till rates come down, you're just losing money. And John, I want to geek out on some numbers here with you and dive into the meeting from our perspective. Inflation, it's still above 3%, around 3.2. Target rate by the Fed chairman is about a 2% rate. I'm going to ask you the question, John. Thoughts on that?
Why does 2% have to be our target rate? I don't understand it. It's in that we are in a different time right now, where inflation is going to be a little bit more than it has in years past. So why can't they adjust their target rate? Why not make it 3% instead of 2%, 2.75, or something a little bit closer, so that we can start making these cuts? And if they wait on these cuts too long, they're going to cause a real detriment to the housing industry and also everything else. It's just mind-boggling on what they're doing. And I hate to say it, but I think when we start to see more, we get a little bit closer to the elections, they're going to start fueling that. Let's get gas prices down. Let's get interest rates down, so that the current administration, it looks better to the general public. But that's BS. Why wait? Why are we waiting? Because just so you can get reelected?
John, I'm gonna even get you more aggravated right now. Okay, so let me help get you more aggravated. Consumer spending is up. It's up. It's not going down. So Americans, right? We're American. We want what we want, and we want it now. We're going to continue to spend money. Hey, listen. Let me say this. Are you going to stop driving your truck? Are Americans going to stop driving their truck? Americans aren't bitching about gas at $3.25, $3.35 a gallon. They pitched a bitch more. That's a mortgage banking term, by the way. And an economics term. They pitched a bitch more when gas was going from 175 to $2 than they are now at 335. We don't care. Consumers, American consumers, are going to buy what they want to buy. They're going to buy it when they want it, and they're not going to stop. All right. So the Fed funds rate, John, which is at 5.5, it's been there for a while, 11 increases in 18 months, 4 holes on the Federal Reserve policy. Rates are not projected to be lowered anytime soon, says Jerome Powell, John. Here's my question. We don't believe, you and I, because we're economists now, we don't believe they can achieve a 2% inflation rate. So is he bluffing? Is he going to make a move, like you said, at 3%, at 2.75, at 2.5? It's not going to 2. I will bet you right now it's not going to 2. And they make a move maybe later in the year, but not anytime soon. That's a lot. I threw in a lot of moving parts there, but it's just the way it's going. We're not going to stop spending money. Stop it.
I agree. I mean, how many more bond sales do we have to have where they go so poorly that it just keeps causing our rates to go up and up and up? I mean, there's no yield for any investors to want to buy these bonds. If rates, they're not making any money if they buy these bonds because our rates aren't going down. So we need to move these rates down, change our target rate of inflation. Hey, what happens if we change our target rate of inflation to 2.75, drop the rates, and then inflation starts to come down a little bit? Maybe it's not an adverse effect like it used to be. Maybe they go coincide this time. Let's try it. It's I don't think it can hurt. I think it'll help. Like I said, the more people that can, the more people that can make money, the more people can give increased salaries, raises, things like that, so people can start spending even more, even though they are still spending. It's a cyclical thing, and it's infuriating to me. You know that, and that's why I do push my buttons.
I do. Well, so I'm even going to push it more, but I'm going to sum it all up right now, John, because we're getting really down into the numbers. And we're just trying to explain to people why it is not advantageous to wait. Okay. So 30-year mortgage rates right now, as we said, they're hovering around 7.25, John. We all know houses are selling if they're acceptable on the market. I mean, they're not staying on the market for long. Consumers, in my opinion, and the data points bear this out, the consumers are accepting these rates as the new normal. Okay, you can go ahead and you can deny it all you want, but you're just kicking yourself on the backside by not buying a house because it's costing you money. All the data points are pointing in that direction. Houses on the market are not staying on the market if they're presentable. There continues to be, John, ready? Multiple offers and above listed prices accepting. There's housing wars and bidding wars going on right now. So this is happening right now as we speak. We could go up and down in any neighborhood you want, in the Woodward Corridor, Ferndale, Berkeley, Pleasant Ridge, Beverly Hills, Birmingham, Royal Oak, Bloomfield Hills, all in that area, downriver, Trenton, and anywhere we're seeing it in Southgate, we're seeing it in Huntington Woods, okay, all over the place. So this is reality. So if you think this is going to end anytime soon, it is not, and we're just getting going into the nicer weathers. Another 30 days, it's going to be spring, John.
Yeah, I mean, just get off the fence. Quit betting like Harry does. Get off the fence. Get off the fence and start making the moves, because our parents did it and it turned out fine. My parents did it in 1982, 16-18% interest rates. Things turned out fine. So get off the fence, start making these moves. Rates will start to come down. We'll get you refinanced. We have so many options to get you refinanced. 0 cost, half cost, full cost, depending upon where you want the interest rate. We've got a great program that'll bring you back if you do your purchase with us for 5 years. We can help you refinance for very, very, very cheap if you've done your original mortgage with us. So there's so many different options, so many different things that we can throw at you to make this make sense. And you just have to listen to the professionals, listen to the real estate agents, listen to the mortgage lenders that are out there speaking truth.
Listen, public service announcement today is as follows. All lenders that are worth anything in the market that keep in contact with their clients will notify you when rates go down. Okay. It is just what it is. That is the lending game. All right. We will always notify you. So that is nothing new. Nothing. It's not new. So if you buy a house now and you get a 7.25 rate, rates go down to 6.25, you're going to get a call. Mark my words. That I will bet on, John. I've been betting on that for 34 years.
Oh, yeah.
So that's an easy bet. That's an easy bet. And as John likes to point out, in our industry, we like to go ahead and forecast. And forecast is another word for betting, but we like to forecast. We'll clean it up and we'll say we're forecasting. So we're forecasting the following. The market's going to continue to stay hot. It's going to continue to be a seller's market. There are going to be continuous overbids and multiple bids on properties right now if the property is presentable. And last but certainly not at least, if you're waiting right now, you're losing money. Now, if you're waiting because you can't find a house, that's a different story. But if you're waiting because you're sitting on the sidelines because you're betting rates are coming down, it's not going to happen. Now, is it going to happen in 5 years? Okay, it's going to happen in 3 years, maybe 2 years. But if you're looking for a house right now and you say, you know what, I'm going to sit on the sidelines, wrong time of year to sit on the sidelines, everybody. John, I'm going to let this, first of all, Capital Mortgage Funding, Hardcore Mortgage Real Estate and Business Podcast, brought to you by Capital Mortgage Funding, powered by CMG Home Loans, 1820 on MLS number, produced and directed by Roberto Bosciani, sitting in the booth. I can see him right now. Roberto, we're going to wrap this up and get last words from John in a second. I do want to, again, public service announcement number 2. If your lender is not calling you back within a reasonable period of time, and yeah, lenders are busy, but if you don't get a call back in an hour or two, I mean, listen, it's really unacceptable unless they're on a plane somewhere, going somewhere, and they should be texting with the communication levels. I was giving a talk this morning, and I was talking to somebody, and I said, "Hey, listen, the fundamentals of lending are the same." John likes to point out that about 10 years ago, I said the mortgage business is easier than it was back in the day. We both shook our heads and said, "Oh, maybe Harry, you shouldn't have said that." It's not easier, but it's not harder. It's just different. The fundamentals are the same. A good loan officer still has control over the conversations they have with the clients and still has control over the documentation and what we request. Now, the communication might be different. Everybody has a cell phone now. You can text, you can email. There was no email and text back in the day, so you actually had to pick up your phone. Now there's different ways of communicating. The fundamentals are the same. The follow-up's the same. You got to be on top of things, and you got to know what you're doing. On the back end, we're all automated. We all have great systems. All right, everything's electronic. Everything is really strong on the back end now. The fundamentals are the same, John Kolb. Okay, the game hasn't changed. It's just the mechanics have changed. But the fundamentals of you contacting your clients and being a great person in the lending industry hasn't changed.
Okay. Yes, the fundamentals haven't changed.
That's all I heard. Yeah. No, thank you, everybody.
But the deep dive into a borrower's position has certainly changed. 300 times worse than it was 10 years ago. Now, did it need to change a little bit? Yes. I think we've gone to the extremes right now, just like we are with the Fed, that they're just overthinking things. And it can sometimes be monotonous and aggravating to a borrower. And I understand it. Let me tell you this. I am not in the business to not close loans. It does not make us any money if we don't close loans. We want to get, if I could get you to the table by taking your name, date of birth, social security number, pulling a credit report, getting a pay stub and saying, okay, you're ready to go, let's go, I would, but I can't. So we're going into this thing as a team. We have to get docs. We have assets that are being bounced all the way around, back, forth between these accounts. Grandma gave a gift. I gave the money back to grandma, but then she gave it to grandpa, who then gave it to my wife. I got to track all that stuff. I'm sorry. And that's just part of life. Asset tracking is the biggest pain in the ass that we do. And you know what? I'm going through a situation right now on a purchase where the buyer's buyer changed jobs 3 days before he was supposed to close. That's a no-no. Don't do that. Especially if you're in an FHA loan, they're going to need a new 30-day pay stub. So we got to wait until you get a new pay stub. So I'm asked to be getting involved to the buyer's lender to see what we can do to help or take the loan over. It's why wait to come to us? You're going to deal with these crappy lenders and they're going to put you in a position. Don't wait.
John, I love it. I love your passion. You've been doing this for a long time, right out of Michigan State University on the banks of the Red Cedar River. Go green.
Go white.
Appreciate that. And Roberto, John's going to have the last words of the day. I'll wrap it up. It's been great, John, having you on the podcast, just you and I, talking about things, the way putting our spin on it, our interpretation. You and I are both pretty conservative guys, and we see things through a pretty pragmatic lens. And I always appreciate the opportunity to converse with you and go over our industry. Thanks a lot for that. What are your last words of the day?
The same last words I usually have is, just, work with a team, get out there, start looking. Had a conversation with a young lady yesterday, her and her boyfriend trying to purchase their first home. And she's kind of like, things are, as soon as we look at it online, it's gone within 18 hours. I said, if you see something online, you got to get out there and look. We had a great guest on a couple of weeks ago, Logan Wirt, who made a statement that said he likes to get his clients out to see homes, even if he knows they're not going to like them, so he can see their thought process, so he can get in their head to figure out what they like, because he's the one that's got his ears to the ground and eyes open. So if he sees something that he thinks they might like, he can call them and say, hey, this is coming on the market soon. Let's go. You need to make decisions quick. You need to get out and look at homes quick. They're going to fly off the market. We have great partners in real estate agents that can help you do that. Make sure you reach out to us. Make sure you reach out to one of our real estate partners. We will get you taken care of.
John, I appreciate it. I appreciate you on the podcast today for Wednesday, February 28, 2024. Remember, everybody, listen to the Hardcore Mortgage Real Estate Business Show, heard every Saturday morning from 9 to 10, 97.1 FM, best sports station in the country. Also, Red Wings are on a roll. We got a team to root for. We appreciate the Red Wings kicking some butt right now. This is Harry Glanz. I just want everybody, if you take one takeaway from this podcast right this second, it's home prices are not coming down. They're only going to go up, and the longer you wait, it's costing you money. So for John Kolb, Becky Alley, Harvey Freed, Lisa Lawson, myself, Harry Glanz, and for our producer-director, Roberto Beauchene, who's in the booth right now, for Wednesday, February 28, 2024, we'll see you soon.